Welcome to The Explainer. So early this year, 2026, the Federal Reserve basically hit the pause button on interest rates, and that sent some serious ripples through the economy. So today, we're going to unpack what that actually means for you, for your wallet, for a mortgage, for your future.
So why is everyone suddenly glued to every word the Fed says? Well, it's easy to think of them as, just a bunch of economists in a boardroom somewhere. But honestly, their decisions have a huge impact on your day-to-day life. We're talking everything from your savings account interest to how much a new car is going to cost you. Their moves really do shape the whole economic landscape. So let's get into it.
Okay, to really get what's going on right now, we first need to understand the Fed's main job. And honestly, the best way to think about it is like they're walking a tightrope. Seriously, on one side of the rope, you've got a growing economy, lots of jobs, that's good. But on the other side, you have stable prices, so things aren't getting crazy expensive. The Fed's entire mission is to walk that super fine line, keeping everything in balance without tipping too far one way or the other.
Right. So the official title is the U.S. Central Bank, and their whole purpose is to juggle two things that often pull in opposite directions, getting as many people employed as possible while also keeping prices stable. It's a real balancing act. Another way to think about it, it's kind of like they're driving the economy like a car. They're always gently tapping the gas or the brakes to keep things moving along smoothly. Not too fast, not too slow.
So, how exactly do they steer this giant economic car? Well, it's not with a steering wheel. They have one main tool. But believe me, it is incredibly powerful. Powerful enough to change the direction of the entire financial system.
And here it is, the federal funds rate. This one number, it's basically the foundation of our entire financial system. So what is it? It's just the interest rate banks charge each other to borrow money overnight. Sounds simple, right? But when the Fed tweaks this rate, it changes the cost of money for the banks themselves. And you better believe they pass that cost or the savings right on to you and me. All of a sudden, the rates on your credit card, your mortgage, your car loan, they all start to move. It's like the first domino in a huge chain reaction.
And this is how it works in a nutshell. It's pretty straightforward. If the economy is overheating, prices are shooting up, the Fed raises rates. That's them tapping the brakes. Borrowing money gets more expensive, so people and businesses cool it on the spending. On the flip side, if the economy is kind of sluggish, they'll cut rates. That's them hitting the gas pedal. Borrowing becomes cheaper, which gets everyone spending and investing again.
Okay, so that's the theory. How does all this apply to what's happening right now in early 2026? Well, after a little while of hitting the gas, the Fed has basically just pulled the car over to the side of the road to check the map and see where we are. So here's what happened. If you look back at late 2025, the Fed was all about stimulating the economy. They actually cut interest rates 3 separate times to give things a jolt. But then, as soon as this year started, they just stopped, put everything on pause. They decided to hold rates steady for a bit, just to sit back and see what effect those earlier cuts were having. And this is the magic number, or rather the magic range, 3.5 to 3.75%. That's where they've parked the federal funds rate for now. They seem to think this is the just right spot while they collect more data and figure out what to do next.
And you're going to hear this phrase over and over again, wait and see mode. That's exactly what Fed officials are telling everyone. They're basically saying, hey, we need to see the receipts. We need more time and more data to really understand how those cuts from last year are affecting the economy. They are absolutely not ready to make another move. So, you might be asking, why the hesitation, right? If things were sluggish, why not just keep cutting rates, give the economy another shot in the arm? Well, it's because the Fed is stuck right in the middle of a classic economic tug-of-war. They've got data pulling them in 2 completely different directions.
And this, right here, is the core of their dilemma. On one side, you have the job market, which is starting to cool off a bit. That makes a strong case for cutting rates to keep things from sliding into a recession. But on the other side, you've got inflation. Prices are still climbing faster than the Fed wants them to, and that argues for keeping rates exactly where they are, or maybe even hiking them.
Let's look at the first piece of the puzzle, unemployment. It's ticked up to 4.3%. Now, historically, that's still a pretty low number, but the trend is what matters. It's a sign that the red-hot job market is starting to lose some steam. For a lot of people, that's a blinking red light telling the Fed it's time to hit the gas again.
But, and this is a big but, here's the catch. Inflation is still stubbornly high. It's hanging out above the Fed's 2% target. And look,
A little bit of inflation is actually healthy for an economy, but too much of it is like a silent tax that just eats away at how far your dollar goes. If they cut rates now, they risk pouring gasoline on that inflationary fire.
Okay, so we've got this big, high-level tug-of-war going on, cooling jobs versus hot inflation. But let's bring it down to earth. Why should you care? Well, because this isn't some abstract debate for economists to argue about. This has a very real, direct impact on your financial life.
This whole wait-and-see thing creates what I'd call a fog of uncertainty. No one's really sure what's coming next. So, if you're an investor, that can mean a much more volatile up-and-down stock market. And if you're thinking about buying a house, it means mortgage rates can be all over the place, which makes it incredibly difficult to plan.
I mean, look at last year. It was a perfect example. The market was constantly trying to guess what the Fed would do next, and as a result, 30-year fixed mortgage rates were on a roller coaster. They were bouncing between 5.5% and 6.5%. Now, a 1% difference might not sound like much, but on a mortgage, that can easily be hundreds of dollars every single month. That's a real-world impact you can feel.
Which brings us to the billion-dollar question, doesn't it? What happens next? Is the cooling job market going to force the Fed's hand and make them cut rates? Or is this stubborn inflation going to keep them stuck on the sidelines for months to come?
Ultimately, nobody has a crystal ball here. The Fed has been really clear about one thing: the data is in the driver's seat. Their next move will be decided by the numbers. So you can bet the markets will be watching, and you should too. Keep a close eye on those next jobs reports and inflation numbers, because those are the clues that will finally tell us if and when the Fed is ready to